And it's the second day of the second half right here in Lagos, Nigeria, watching Business Incorporated. Here's what's coming up in the next 55 minutes. Top internet service providers in Nigeria record a significant drop in customer base as Nigerians cut their spending on internet services. Moody's Ratings cuts its assessment of African Export-Import Bank's debt closer to junk status. And South Africa's inflation expectations slide to the lowest level seen since early 2021. And it's good to have you join us. I'm Ladi Williams. Just going to check on what's playing out with most of the markets that we track as usual, starting with oil. Now we see it's a big jump there for both grades there. Brent crude, 1.12% jump, $67.86 a barrel. We're seeing strong moves there to start the second half of 2025. WTI crude also 1.12% up, $66.18 there, almost closing that gap between Brent and WTI at this time. We see Brent is traded between a high of $69 a barrel and low of $66 a barrel since June 25th. That's concerns of supply disruptions in the Middle East producing region. That's ebbed following the ceasefire between Iran and Israel there. So we're seeing a strong start there with the trade. Let's get a check on metals market now. Gold prices held steady in Asian trade today after sharp gains in the past two sessions, supported by U.S. fiscal deficit concerns as the Senate passed President Donald Trump's tax and spending mega bill there. And we're seeing spot gold, U.S. gold, spot silver there. Yeah, that's mostly green, but red there. Forget the arrows. You see palladium, that's up 1.90%. Platinum, 3.08% there. We see the big movers right there. Gold has risen more than 2% this week so far, erasing losses from last week when Israel and Iran ceasefire reduced its safe haven appeal there. So that's what's playing out for those markets. So other stories now. Top internet service providers of the country have recorded a significant drop in customer base as Nigerians cut their spending on internet services there. Top among the ISPs include Spectranet, FiberOne, and Starlink, according to the latest report released by the Nigerian Communications Commission, NCC. Total active customer across 127 ISPs dropped to 289,369,000 there as 60. That's for Q1 2025, and that's down from 307,946 recorded in the third quarter of 2024. Tech analysts have attributed the decline in the number of ISP customers to several factors. Key among them, which is the cost of data, equipment, power supply, as well as the tariff hike implemented in February this year by all network operators. Meanwhile, the Nigeria Communications Commission has approved a 3-year national roaming agreement between MTN Nigeria Communications PLC and Emerging Markets Telecommunication Services Limited, also known as 9Mobile, enabling 9Mobile subscribers to access MTN's network infrastructure across the country. In a statement released to the Nigerian Exchange, MTN Nigeria says the agreement would span 3 years, allowing 9Mobile subscribers to access and roam on MTN Nigeria's expansive network infrastructure across the country, where 9Mobile lacks adequate infrastructure. And a recent report by an AI and machine learning specialist there, that's Abiodun Ajanaku. The report represents a pioneering application of artificial intelligence and machine learning in evaluating startup risk and investment readiness within the African innovation ecosystem by developing a predictive model trained on simulated data set of 10,000 startups. The study introduces a highly accurate, explainable, and scalable tool for de-risking early-stage investments. Let's hear now more from him now. Janaku joins me from the UK. Great to have you on the show. Hello, Abiodun, can you hear me? Okay, yeah, we'll try and get Abiodun back there to help us unpack how AI, can help investors, find out which companies to actually invest in, especially when it comes to early stage companies there, it can be difficult because you don't really know what that company can do because it's just, startup at this time. So yeah, it gets really risky. So it'll be interesting to see how, artificial intelligence and machine learning can, direct investors on which companies to actually, take that bet on, hoping that you can, make back your money or exit, with profit. But we'll try and get Ajanaku back there to help us unpack his report there. But let's look at other matters now. See, financial institutions and regulators are stepping up efforts to deepen understanding of cryptocurrencies in Nigeria's evolving digital economy. We see Quidex Technologies Limited, in collaboration with the Securities and Exchange Commission, that's for Nigeria's Financial Literacy Technical Committee, they hosted a pivotal event titled Understanding Cryptocurrencies for Financial Institutions. Take a listen.
Blockchain. The growing adoption of cryptocurrencies has made financial literacy more critical than ever. This event brought together bankers, regulators, and fintech experts to explore how digital assets can integrate safely into Nigeria's financial ecosystem, balancing innovation with compliance.
Using cryptocurrency is actually a sensitive issue for us because we don't regulate currencies. It's the CBN that regulates currencies. So on the back of this growing youthful technology savvy population, which is the youth, also there's a talk about why the young people have different portfolios from the older people.
Also top on the agenda is the role of regulation and trust in driving crypto adoption in asset management and securities.
Where we went to the regulator, we said, this is what we're doing. What is the framework which we can fall under, right? So that it gives confidence to our customers, it gives confidence to the market, and then it gives confidence to you that we're doing the right things.
Africa, I would say, from Nigeria is not really where we're experiencing that the most for asset managers and banks, but it's more in South Africa right now that the banks are starting to warm up to the idea. You've got 250 odd regulated entities, so we're seeing that. And I guess it's, first it's proof that it works and something good to come to see for Nigeria, but not necessarily a warning message, but say that now we have a lot of different countries in Africa that are opening up, right? You've got Ghana, you've got Kenya now looking at it, you even have markets like Morocco.
With Nigeria ranking among the top crypto adopting nations globally, today's discussions mark a crucial step towards institutional readiness.
All right, that was space right there in Nigeria. There's also this new trend about internet capital markets there. So much happening, but we'll drill down on that later on. But let's try and get Abiodun Ajanaku now, who's an AI and machine learning specialist there that's developed this latest report. Abiodun, I don't know if you can hear me.
I can hear you loud and clear. Thank you for having me, Ladi.
Fantastic.
Super excited to be here.
Yeah, it's great to have you. And, definitely, at this point, it almost seems like we are putting a lot on artificial intelligence, yes, right now. And, from your report, you're saying, angel investors can actually, use AI and machine learning, to determine, good startups to actually put money in. Tell me about, your report and your findings.
Thank you so much, Ladi. If you look at the traditional approach to carrying out DD on tech startup, it's very time consuming. It can take between 3 to 6 months to get it done. And this is really, really a daunting task to start up, because by the time you finish the due diligence, right, the startup might not be there anymore for the investment. So I've developed an AI power to be able to assess startup risks and investment readiness just within minutes, within days. You're able to gauge the risks associated with a startup, and whether the risk is low, whether it's medium, whether it's high. And I think this is a very powerful tool to several stakeholders, like investors who are looking for more transparent, scalable, and a very structured tool to be able to assess and gauge the risks associated with any business before they put money. And the tool is also very important to policymakers as well, to be able to design capacity building programs for startup to continue, for them to continue to innovate their growth, and also around allocation of resources. The beauty around this model is very, it's also aligned with the mindset of investor. If you look at investor think like risk manager, it's more about managing risks, more about reward. So this particular predictive model sort of penalize any high risk startup to be put forward as investable. You don't want that. You don't want to make poor decisions around your investment and opportunity. And the good thing about this tool is very scalable, and it looks at both startup risks and investment readiness. Investment readiness is very important. All tech startup needs to pass due diligence before money is put in their business. And for you to pass DD, certain aspect of your business needs to be reviewed, from financial, looking at your revenue, your cost, your burn rate, your total assets, and all of those stuff. Also, you also be evaluated based on your operational metrics, things like your employee count, the founder track record in managing tech business. Those are very important. Like I said earlier, traditional approach has so focused on just the quantitative side of this startup when they are doing due diligence. But my tool has adopted what we call a mixed approach. It's combined both qualitative and quantitative data to be able to assess these risks. I'll give you for a good example. One part of DD that's always overlooked using traditional method is around the market traction. For the fact that the startup is not making revenue now, do they have a very decent product market fit? That is also very important, to be able to gauge the potential of that startup as much as possible. Also around compliance. Compliance is one of the biggest issues facing startup, when it comes to due diligence, beyond just funding, The tool also allow them to be able to recognize and identify the risks associated with their business. And once they identify the risks, what are the mitigants they need to put in place to sort of reduce the likelihood, the impact, and severity of the risks around their business.
Right.
And then
right.
that will prepare them for a better due diligence and with investors.
Okay.
Thank you.
All right. So, Abiodun, definitely, sounds great, at this point. But is there a possibility or a risk that, a business or a startup might not look that strong, but, somehow can scale? If they're able to receive, investment, is there a possibility, of that kind of risk there, that won't allow the AI to actually advise investors to actually go into it?
This is a very good question, Larry, and I'm so happy that you're asking me that question. With these two, also what the tool looks at is high-promising investable startup. You want to ensure that they are not omitted from investment due diligence. So back to your point around, is there a possibility of, taking startup that have not started generating revenue and all those stuff? So there are other metrics you can look at. You can look at the founder experience. Do they have a very good founder strength score? You can look at the product market fit. Is there a good alignment between the product of the company and also the market? So you want to ensure there's alignment between the product and the market. Although a startup might not be generating money, but if they have that good traction potential, you can put them forward as investable and investment worthy during the process.
So what key features would you say that's, maybe, for example, data compliance, IP ownership, founder strength, score, did this model identify as the strongest predictors, of investment readiness? And how should investors, prioritize, these during evaluations?
This is a very good question again, Ladi. Based on the algorithm flag about 5 most influential features that are very important beyond the quantitative revenue. Things around the product stage is also very important. If you look at the life cycle of any business, their product will go from ideation to MPV, from MPV to growth, from growth to mature. The product stage is also very important. The funding stage of that business is also very important. And also another key factor or features is the market traction. I spoke about it earlier. It's also very, very important. The fact that a startup is not generating money now, but they have a very good user base, is a very, very important matrix that should be considered. And the algorithm flagged market traction, which measure not market fit as one of the ways.
Ajanaku, sorry, Abiodun, so sorry there. I have to, butt in, but you will continue, with your thoughts in a few moments. I just need to sign on this live coverage there. It's a formal commissioning of the Abaranje Road there. We'll be joining that on DSTV, but we can continue watching Business Incorporated on all other platforms. But thank you so much, Abiodun, for helping us break that down. But at the end of the day, how much assurance do we have from this model? Do you think investors can actually put in this model with a minimal chance of actually losing money?
Now, if you look at the model, what has been put in that model is about 12 years experience supporting, tech startup in different incubation acceleration program. And when you talk about AI, the most important thing is the domain expertise you are bringing. So when you combine domain expertise, with AI capability, what will come out of this is context-aware algorithms that will be very practical and investor can use to drive and measure risk as quickly as possible. Based on the performance evaluation on the matrix, on the average, the performance is about 90% accuracy, right? But what has gone into it is a combination of domain expertise, number one, a lot of rule-based that reflect industry benchmark, and I think it's a very practical tool that investor, organization looking to support tech startup, policy maker, and so can use. It's just the minimum viable version of it. I'm still trying really hard to also improve and come up with a very revised version. But a lot of people have been using it, and the feedback has been very, very positive.
All right, so given the model's clustering of startups into low, medium, and high-risk categories, how might VCs, tailor, investment terms or, support mechanisms, based on each risk profile?
Thank you very much, Ladi. So if you look at startups that have been clustered around low risks, what jump quickly is they're already they are very close to investment readiness. They have a very strong market traction. They might also have started generating revenue in a way. They have a very good financial governance. They have a very strong founder experience in terms of leadership, managing tech, similar tech business in the past. And also they have a very good data compliance, and also their product is already at that advanced stage. So any startup categorized into that low risk, that's what you get. Startup categorized into that medium risk category, they are emerging, they are not fully there yet, but they have a good or relatively decent, market traction. They've started, generating revenue. Their compliance-wise is not as very weak as those in high risk. So startup classify into high risk, what the algorithm has done is to cluster them to look at, what I've just mentioned. They don't have revenue. Their market traction is very low, so therefore their risk will be high. Compliance, in terms of compliance, they have some audit flags as well. So you can box all of those as high risk. They may or not be investable or investment worthy. But I think the focal point is you want to pay attention to the startup at that low risk and medium risk, because it's very, very important. Also, you don't also want to misclassify a very high risk startup as low risk. That would be, we call it type 2 error. And that's what the algorithm try to penalize, so that no poor investment is made at any point in time. Like I said, you don't want to classify a very high risk startup as investment worthy or investable. So the algorithm penalize that and ensure that one of the key metrics, because it's a classification problem, is called recall, to penalize and minimize the possibility of putting forward such startup as being investable.
Great work you're doing there. I'll definitely keep an eye on development on that AI and machine learning pool there. But, definitely, I know, so we have some investors that are, high risk takers, and, they like high rewards. I'm sure they'll be, they'll also maybe like to identify, with this tool, Well, thank you so much, Ajanako Abiodun. He's
Yeah.
an AI and machine learning specialist. We'll carry on and continue this conversation another time. Thank you so much.
Thank you so much for having me, Ladi.
Fantastic.
Yeah.
All right, now let's look at global monetary policy. At this point, we see at the annual ECB Forum on Central Banking that's held in Sintra, Portugal. I think that's ending today. The world's top central bankers, including Federal Reserve Chair Jerome Powell, ECB President Christine Lagarde, they were there to address twin challenges of communication in crisis and preserving central bank autonomy amid increasing political pressure. Let's see what African central bankers should be doing now to hedge against most of these global risks. We're also seeing that in the currency side of things. Well, joining us to discuss now, we have Julian Caragosian, is a former special advisor at Canadian Ministry of Finance and also a visiting lecturer at Department of Economics at McGill University. It's great to have you on the show, sir.
Thank you for having me, Laddie.
So, definitely a tough time when you look at what's playing out in the U.S. with, the relationship between President Donald Trump and the U.S. Fed Chair Jerome Powell. In your experience so far, have you seen this type of relationship before with the central bank and the executive, and what does it normally lead to?
Well, this in terms of the last 40, 45 years is rather unprecedented. Typically, the White House and the government of the day have been pretty hands-off. The only example is the appointment of Paul Volcker in the late 1970s to bring down inflation. But there you had political alignment with monetary policy. What we're seeing today, the tension is that President Trump has indicated directly and indirectly he'd like to see lower rates, which is a big break from convention. But with the recent court decision that upholds the independence of the Federal Reserve, I think that's one victory for independent central banking, if that's the objective. But I think also at a even bigger political level, there's one thing that gives President Trump pause to think before he acts, and that is the stock market. And the U.S. equity markets and global equity markets would not like it at all. There would be consequences if President Trump tried to directly interfere and even remove Chairman Powell, which he does have the right to do, and put in place a banker that would be more amenable to the political cycle. Markets would not like that. And again, one thing Donald Trump has backed away from is upsetting markets too deeply. We saw that in April, and he backed away towards a deal with China in order to restore market stability.
All right, but with what we're seeing, playing out there, definitely bringing it down to Africa at this point, and we're still seeing central bankers here. Some African countries are winning the war against inflation and keeping their currencies stable, but we see some countries actually struggling at this time. What do you think African central bankers should be doing at this time to learn from what we're seeing playing out there in the global stage to actually keep things tight here in Africa?
Well, I think it underscores the importance what's playing out globally in the U.S. and elsewhere. I think it underscores for the entire world the importance of having, we need central bankers that are accountable to the people, absolutely, but we also need central bankers who in the day-to-day management of the money supply and interest rates with the objective of creating price stability, it's absolutely critical that they have independence in achieving these objectives. Ultimately, they do have to be accountable to the population. And in a democracy, that means to democratically elected officials, to the government generally. But in their day-to-day management, they need that type of independence. And so that's one of the big, you could say, lessons or, lessons that is coming out of what's playing out in the United States right now.
Right, and we've seen instances, in some countries in Africa where, the central bank, kind of acts too powerful and, takes on some kind of decisions that actually work against the country. What's to be done in that kind of situation?
I think, and we've seen examples of this in the North and in the global South, where central bankers, we've seen instances where central bankers right across the world, in some cases, have taken too harsh a line on controlling inflation, some even believing that zero inflation is the right number, which is extremely rigid. You put an economy in a straitjacket and you squeeze growth and investment out of that economy. So economies do need some inflation because quality typically rises over time. And so the inherent price of goods and services needs some flexibility to grow. And so again, it's really a balancing act between not letting the so-called the toothpaste out of the tube, letting runaway inflation, but also avoiding deflation and stagflation or stagflation.
And going forward, do you see some kind of collaboration between the global central bankers at this point? Do you think they're going to come together to try and combat global inflation and global currency issues? Is that what you're seeing?
Right now, there's so much geopolitical divergence globally, and I'm not talking just about between the US and China and the West more generally and China, but also within the West. The Trump administration, a lot of their trade policies and trade policy uncertainties have been aimed actually at, in quotation marks, allies and partner countries. And this doesn't bode well for monetary policy cooperation. We've seen Christine Lagarde and other European central bankers saying publicly that this is the moment where the euro can gain globally as an international currency. So there seems to be more competition on the horizon rather than more cooperation.
And we also say we've heard some quarters, talk about, stable coins and Bitcoin at some point trying to solve, some of these currency problems in the world. Do you see that as a possibility?
At this point, I don't, just because if countries like the United States, one thing that ties the United States and China and Europe and the rest of the world together, or much of the rest of the world, is that they want to maintain their national currencies as the medium of exchange and store of values in their countries and globally. And I just don't see them in the foreseeable future giving away any kind of latitude to stable coins and cryptocurrencies.
All right, thank you so much. There, so much respect. At this point, we're done with the first half of 2025. Now, on to the second half. At this point, we'll see how things go. Thank you so much for coming on. Julian Carrick-Grisson is a former special advisor, Canadian Ministry of Finance, and a visiting lecturer, Department of Economics, McGill University. Thank you for coming on today.
Thank you, Matthew. Thank you for having me.
All right, we'll take a break now. When we come back, we'll head straight to the markets, find out how the markets are doing globally and domestic. That's in a moment. Just stay with us. All right, let's head straight to the markets now. Find out who's making money and who's not. At this time, we have Anete. He's going to give us the details at this point. Anete, good to have you. Second day of the second half of this trading half of 2025. How's it looking?
Well, Ladia, I'm glad you mentioned second half. The year has actually been split. Let me
right in the middle, smack there.
We spent 183 days and is 182 days out of 365 days. I've done the math already.
Wow, that's a very important math.
And then still talking about doing the math, that means that the market on the last trading day of June was in the red, but kicked off the first trading day of July and the second half still in the red.
Like a hangover.
Like a hangover of profit taking. And that has lowered the, you were the one that took the markets.
Exactly, below the 120,000. Is that a psychological level now at this point?
I wouldn't say it's this psychological
level.
Well,
now it's turned to some kind of resistance?
Resistance, but I'm sure the market is going to make some stronger comebacks in days to come. Don't forget, we still have about about 5 months plus, because this week is already counting its way out. So we have about 5 months more for the market to do some little bit of magic, which I'd wager that this market might hit a 150,000
All right,
basis
we'll
point.
keep watching that wager,
Okay.
at this point.
All right. Okay, so now let's talk about the market's intraday trading numbers. This is how it was about some 1 hour ago, although we've also had some market updates which shows that the market has rebounded. Banking sector is now up by about 2 basis points, supported by increased demand in Wema Banks, Sterling Bank, Jais Bank, Access Core. But on the other hand, the insurance subsector of the market is not doing pretty well. Talking about the market, the Wema Bank, which I mentioned, is currently the most traded stock by value. Royal Exchange is the most traded by volume, and the total market turnover is currently at 824 million units. But this was the last number that we track in the green territory, 0.03%, 119,780. It's not too far from the number that it closed Tuesday's trading session, 119,780, and that's down from the 120 that we saw. But we're hoping that that 120,000 mark will be able to come back, and then investors can also smile, because that measures what the sentiment of all the stocks listed, nearly 300 stocks listed on the Nigerian exchange trading floor. Now, the Johannesburg Stock Exchange in the red at intraday. So this was the lone loser there at intraday, but still slightly comfortable in the 96,000 level. Hasn't gone too far from what we saw yesterday, and we're hoping that that market will close Wednesday's trading session in the green. Now let's take a look at the other markets on the African continent. We see the EGX and the Nairobi Stock Exchange All-Share Index closing Tuesday. That was I would say that this was the biggest gainer yesterday, although the rest are trading at intraday. Intraday for EGX 30, as you can see, there's 0.43%, 32,830.50, while Nairobi Stock Exchange All-Share Index 156.58 for the close of Tuesday's trading session. Okay, so we're talking about the fixed income market this time, not the equities markets. We're making a side switch, and we saw that yesterday for the fixed income market that it was a bullish trading for both the treasury bills market as well as the bond space. And yesterday we also saw that the market is expected to have a bit of the market is expecting that Q3 bond issuance calendar. And as we speak, the market is still in the positive territory. But let's talk about the review of the first half, the second quarter, as well as the month of June, which has just ended not too long ago, just about some 48 hours ago. And we'll be bringing Orelua Odetunde to tell us more about this market. We're going to be reviewing that with her. Thank you for joining us, Orelua.
Thank you for having me.
I'm sure that the fixed income market, it really performed well. I'm just guessing. But can you tell us what was the overall performance for both the treasury bills market, the bonds market, actually the debt markets? Can you give us a little bit of insight into the performance?
Certainly, and like you rightly mentioned, we did see bullish activities really dominate market sentiment in the first half of the year. I mean, I think when we ushered in the Q1, we did see that in the first quarter there was a treasury bill issuance, there was a treasury bill calendar issuance, and it definitely showed that there were supposed to be some net injections at about 900 billion into the market. So definitely investors started to price in more liquidity in the fixed income market, and it sent a very strong signal to them as well. Aside from that, I think also in the bonds market as well, we also saw that, you know, there was a 10-year bond that was issued in January 2025, but as of February 2025, that 10-year bond was taken off. So it was clearly signaling, and you know, that 10-year bond was also issued at 22.6%, which was the highest coupon debt that we currently have on offer. So I mean, investors took it out in the next auction in February, clearly to signal that they were moving away from the high yield or the high coupon debt environment, so to say. Apart from that as well, we also saw foreign portfolio investors. There was a surge of foreign portfolio investments in the fixed income market. And remember that we saw OMO yields in December 2024 at around 31%. But you know, I think that, that also brought about a lot of stability in the FX market. We did see that, FX rates started to also stabilize when foreign portfolio investors started to come into the market. As a result of that, OMO yields started to make their way down. OMO yields that were around 31%, I think currently they are now around 24, 25%. So, foreign investors got comfortable with our market. They started to bring more inflows in due to the stability that we saw in the FX environment. And as well as inflation as well. We saw inflation make its way down. As of the last print, inflation was around 22.97%. So I think that investors also priced, those lower inflation numbers into the fixed income performance in the H1, and that was why we saw, very bullish sentiments that rocked the market in the first half of the year.
I'm glad you mentioned insurance. So, I said insurance, inflation.
Yeah.
Inflation is one of the key determinants of the market sentiment, even in the equities market. But can you tell us more about this inflation imprint, particularly for the month of June, comparative with the month of May? How did it affect investor sentiments?
I think investor sentiment generally about this new inflation series we're seeing, I think sentiment was a little bit mixed.
The rebased one.
Yes, the rebased one, so to say. So I think on the positive side, we did see, investors getting much more comfortable with our inflation numbers, because in terms of like our food index weightage, it's much more comparable to where we see other African economies. They also have a 40% weightage on their food index. So it means that to foreign investors will be much more comparable across other sub-Saharan African economies. They don't necessarily need to adjust our inflation figures, to a lower weightage of food. I think the second thing also that, we saw, for investors that they got more comfortable with was also the fact that, this inflation figure was now much more reflective of consumers' consumption patterns as well. There were introductions of new indexes, so we're starting to see more color on inflation, so to say. So, but I think the negative, on the flip side, what we saw was that, there was a new methodology, but what we saw was that this MBS didn't necessarily release the previous inflation figures under the new methodology. So I think now inflation is a bit more difficult to forecast. A lot of analysts don't have those historical data. So the history definitely informs where the future inflation figure should be. So we don't necessarily have those past inflation figures to use to forecast these newer inflation numbers. So I think put all of that together, I think perception was somewhat weak, but so to say, overall it was mixed sentiments that played out on the inflation data.
Okay, so now when you mention this, we're still looking at inflation, because in the next 2 weeks we will be expecting the June inflation numbers to be out and for this month of July. So looking forward for the second half, third quarter, and this month, what are your expectations? So
I think our expectations is that we do expect to see more issuances in the second half of the year. Recall that, in H1, what they have raised in terms of like the domestic debt market, particularly in the bonds market, is around 2.8 trillion. And compare that to 2023, I think they raised around 3.5 trillion. 2024, they raised around 4 trillion. So it's clear that we are seeing lower issuances this time. But we expect that, there will be a pickup in H2. We have a record budget, definitely over 50 trillion. We also have a record budget deficit as well. They will need to, definitely fund that. They'll need to fund that budget deficit gap, definitely. And we know in terms of revenue, we also expect some form of revenue shortfall as well. Remember that, recall that 60% of our oil, 60% of our revenue is expected to be generated from oil, especially oil prices. And we've seen oil prices that is currently below $75 per barrel in terms of the benchmark, and also oil production as well is way below what the federal government has already set for its estimate of its revenue in 2025. So I think clearly we should put all of these factors. We also expect a revenue shortfall around 7 to 8 trillion as well. We expect that investors will start to price that in, and that will have some impact on fixed income yields, which we expect to go higher in H2. But I think one thing that this the DMO is currently trying to do is kind of manage its borrowing cost. So if you take a look at the May bond auction that we had, as well as the June bond auction that we had, you would see that they were clearly raising what they had on offer. And we know that previously the DMO had that penchant of always wanting to raise more than they offered to the market. But this time they raised exactly what they offered to the market. So clearly they are trying to manage their borrowing cost. But in the second half of the year, like I said, we have a high budget deficit. We have we have revenue most likely that will have a shortfall. So so to say, we do expect that issuances should be higher in the second half of the year.
And I'm hoping also that the government will be able to reduce its debt, because the debt has ballooned to about 149 trillion naira as at the end of the first quarter of 2025. But we thank you so much for your analysis on the show. Aurelua Odetunde, research analyst with Ancoria Asset Management. Thank you so much for your time on the show. And we hope to see you next time doing the same thing that you're doing right now.
Thank you.
Okay, so we just talked about the fixed income markets, but let's go back to the equities markets, and that's within the Middle East, Middle Eastern market. Yesterday, these two markets were in the green, but this time at intraday, they are in the red, and no thanks to, of course, we always know that once the market is in the red, it's profit-taking. At some point, it's not just profit-taking. It could be some factors, maybe geopolitical, economic, that could affect it. But so far, the markets are red at intraday. But for the other markets within the region here, it's okay. So that means that it's only the Qatari Stock Exchange that is in the green at intraday 0.01%, while the Saudi Arabia's market was in the red 0.15% and poised to close the market in the red. Tomorrow will be the last trading day for the week for the markets within the Middle East, except for the United Arab Emirates indexes. Okay, so let's fly over to the United States, and we see that the stock futures there, stock futures are kind of in a mix, not too good picture there, except for the Dow Jones Industrial Average, which is, of course, is climbing higher into that record high, which we had seen yesterday. And of course, yesterday we saw that the markets were in the green. And this is coming also at a time that U.S. President Donald Trump had the Senate had narrowly passed his tax and spending bill for the market. And we also saw that some of the shares of U.S. banks were trading higher in the pre-market session. And that's after firms announced that most of the banks such as Citigroup, Wells Fargo, and the Bank of America, they announced a hike in their dividend after the Federal Reserve's, that's the U.S. Central Bank, the U.S. Federal Reserve's, announced the latest stress test for all the banks. So a stress test is being conducted within the U.S. banks there. And of course, it's looking very pretty good for the markets within the United States. But what would the market be expecting? It's a holiday shortened week, because Friday will be Independence, well, that's Independence Day for US, which is marking over 200 years. So the markets will be closed on Friday, but the market will be looking out for the jobs report and the ADM big jobs report for the month of June. That's the jobs market report. And for the Asian markets, it's a kind of a mixed picture there for the Asian markets. So, Ladi, that's a wrap for the markets.
Right.
I don't know which pick you want, if it's the red or if it's the green, and why.
Well, we'll definitely keep trying to pick at this point, but thank you so much, Anita, there for those details there with markets that we track. But let's take it on and find out what's happening in Europe now. We have Lars Holter. Great to have you, Lars. What are investors looking at in today's markets?
Well, hi, Ladi. Thanks for having me here again. I wanted to give you more good news because when I checked the markets here a little while ago, we were actually all in the green, but looking at it now, the mood isn't that strong to support that any longer. The CAC 40 over in Paris, the only index right now in Europe that is still holding on to some gains. We see the DAX down. We see the FTSE 100 down in London. So it seems we've started this week slow and we're keeping it slow. There's really not much going on here. The news anyway isn't really coming out of Germany, not even out of Europe right now. I mean, you just talked about it too. Investors are eyeing all the developments, of course, in the United States as that big bill that is debated, because that will have an economic impact not only on the US, but by extension, of course, for the rest of the world. And then there is, on the positive side, social media statements and the developments here that are pointing to the possibility of a longer ceasefire between Israel and Iran. So again, the news is coming from elsewhere, from outside of Europe. Any de-escalation, of course, in the Middle East is good for markets, good for oil prices, but nothing is really breaking through, and that's why we're seeing very little movement in markets, Ladi.
Right, I guess it's a calm, scenery there for most of the markets in Europe, but who knows, maybe the calm before some kind of storm or bullish storm. We'll keep tracking that. But taking a broader look European markets have been they've been quite strong, of late, and much stronger than U.S. Markets. But some new numbers suggest that it doesn't reflect the economic reality. What can you tell us about this?
Yeah, that is true. Look, the economic researchers keeping track of global companies' revenues, their profit, and last and certainly not least, their share price or their performance on the stock market. Now, looking at these numbers, we can see that despite what markets are showing, U.S. companies are actually far outpacing European companies. Let me give you some numbers here. We're looking at the 500 biggest companies on either side of the Atlantic. Those in the U.S. have seen their profits rise 1.5% over the past year to an all-time high of 1.3 trillion euros. The 500 largest companies in Europe, however, have seen their combined profit drop by around 5% to 616 billion euros. That is less than half the money those US giants are raking in. It's really interesting to see these numbers in the midst of a global trade war, of course, started by the US. But the economists here are pointing out that the US domestic economy is still doing pretty well. It's good for about 87.5% of all these profits, whereas, of course, the domestic economy here in Europe and specifically in Germany, that's still lagging.
All right, thank you so much, Lars. We'll definitely keep tracking that data and see if some kind of switch, happens going forward. Thank you so much, Lars Holter.
Yeah, thank you, Ladi. Thank you.
All right, so some other news now. See the rand that weakened about 0.2% to 1762 to the dollar amid anticipation of the Bureau of Economic Research Q2 inflation expectation survey. The result informs the Reserve Bank's upcoming interest rate decision. Meanwhile, markets await U.S. labor data and global trade talks ahead of the July 9th tariff deadline. But let's pivot now to another conversation. Now, we see Africa has long been sidelined by big tech's one-size-fits-all, artificial intelligence approach. But Sahara, a decentralized AI platform backed by major tech names, is writing a story with fresh funding from Samsung Next, Pantera Capital, Binance Labs, and more. Sahara is leveraging blockchain to reward African data contributors and trainers. Well, join us to unpack this now. We have Toby Olatunji, the CEO of Intron, joining me there from the U.S. Great to have you on the show, Toby.
Hi, thanks for having me.
So talk to me now. How do you think Sahara is aligning its model with Africa's specific challenges? Like limited data infrastructure, language diversity, and especially mobile access.
Yeah, thank you. I think when we started Intron and we tried to build voice services, first for healthcare, of course, the very first problem was that there was no data to train models. Existing models worked very poorly for Africans. Many people spoke with different accents. And as you can imagine, like when you use your Alexa, use your Siri, there are several things they don't understand, names of artists, names of songs, and all that. And so there was no quick way to solve that problem. So we had to go out there and try to collect data across Africa. So we had to build a platform to recruit speakers from right now over 30, 40 countries, and people contribute data to us every day. So we use that data to train models that actually understand the accents, dialects of even to the over 300 accents across Africa. So that's the way we're able to train these models, expose them to African names, to names like Chinwe, Ladi, or something like that. They now understand when you say these names, when you say African currencies like Naira, shilling, and things like that, and they perform much better for African accents because of the exposure they've got into this data.
All right, so looking at Africa, most African countries, there's that push now, to produce more, at this point, to move away from exporting just raw materials to actually producing, finished goods. But it seems like we're also seeing this in technology. Africa imports a lot of, technology from what we're seeing, so far. What do you think Africa should be doing now to get to a point where we can actually be also, kind of self-sufficient, when it comes to, technology? Let's start like producing technology, out of Africa and maybe coming up with the next big thing? Well, what should we be doing now?
Yeah, I mean, absolutely great question. I was having a conversation recently about the Middle East. I think their playbook is definitely a starting point for how do you take whatever you have, your oil money, and invest it back into your people, invest it back into infrastructure, tourism, electricity. I think there are some foundational pieces that would help the countries make progress and even catch up with the West, because there's just some fundamental pieces that young people need to, because there is talent, there is a lot of innovation. There are people who have the skills, who have the exposure to build great things, and so if they're given the right infrastructure, very basic things, electricity, Wi-Fi, just safety, things like that, just providing the environment. Of course, capital is one big piece. If we take some of that oil money and let's say 10% of it or 20% of it and invest it into building these systems, these platforms, I'm sure that that stimulus will find those that need it and lead to even bigger companies than what we've seen today.
And in your view, from what we're seeing so far, do you think Africa can invest in its own technology advancement?
Absolutely. I mean, there's small pockets of it. You're already seeing the government has some decent initiatives. There are foundations that are doing really good work already. I think Tony Lumelu is one of them. There's multiple small pockets of investments here and there. I know there's the BOI, there's the AFDB. So there's stuff happening. It's just that the scale is still small compared with the amount of demand. There are millions of young, there are small and middle income businesses, and so if there's tools put in the hands of these people, I'm sure that we can make big things happen.
All right, looking at the economies and the business climates at this point, how are you seeing some of this technology you've come across? How are you seeing them improving the way we do business in Africa, Nigeria, and the economy at large?
Yeah, I think we have found a lot of really interesting use cases for our technology. Our core technology is voice to text, so you take voice and you can transcribe it accurately into text. I can imagine that there's at least 3 very valuable real life use cases that we're doing. One is healthcare. You have doctors who are struggling with documentation. They see so many patients every day, and the time it takes for them to write notes for each patient takes away from the time they have to see patients. And so if you provide them a tool that where they use their voice, just dictate their notes on the fly, hands-free, then you give them time back. You reduce the amount of time patients are spending waiting, and it increases the amount of data the hospital has to make decisions. Another really great example is the courts. So you see there's a judge, there's a witness, and there's a lot of talking. All that discussion back and forth has to be written down. And so you have a situation where it takes courts so much time to transcribe and make court transcripts available. All your cases, your judgments takes several hours to write. And so if you give these guys tools where just by while they're speaking, you're already taking that voice and transcribing it to text, you save them a lot of time. People have to wait less, and justice can be delivered much quicker.
Right, and we do need, justice delivered as quickly as possible, at this time to reduce all those backlog of cases. But thank you so much. It was great having this conversation with you, Toby Olatunji, the CEO of Intron. Thank you for coming on today.
Thank you.
All right, so the stories now. We see South African consumers and businesses now anticipate notably lower inflation, with expectations dropping to 4.3% in the first quarter of 2025. That's the lowest level seen since early 2021. And according to Bloomberg analysis, this moderation comes as the Reserve Bank shifts towards interest rate cuts, reducing borrowing costs. And we see East African central banks, notably Kenya's, increasing gold reserves as a hedge against volatility in global markets, although Kenya's holdings are currently minimal. Then Moody's ratings have caught its assessment of African Export-Import Bank's debt closer to junk status a month after Fitch Ratings did the same, citing weaker than expected asset performance. Then let's get a quick check on what's playing out with the crypto market at this point. We did see, Bitcoin there trying to, get above that 107,000 level, but that did not play out at this point. We're still seeing Bitcoin there struggling between $105,000 to $106,000. Then we see Standard Chartered there reaffirming a forecast of $200,000 by the end of 2025. That's for Bitcoin. Some would think that's quite an incredible forecast there. That the ECB is considering blockchain settlement pilots at this point. That was part of the top conversation there. In Portugal, yeah, we know the central bankers like stablecoins, and Bybit and OKX, they're expanding their crypto services in Europe at this point. So that's it for the second trading day of this second half of 2025. We'll bring you up to speed so that you make those good investment decisions going into the second half. Thank you so much. I'm Ladi Williams from me and the team right here at Channels HQ. It's bye for now.